In our project, we use Porter's 5 forces to map the pressures on AXA Insurance Company and what they mean for a sustainable advantage in the market. Supply power for AXA is moderate to high because of 8 main factors explored here. Inputs are specialized, such as reinsurance, broker access, and expert talent, so they tend to be hard to replace. This makes relationships sticky, with high switching costs tied to shared data, models, and renewal credibility. Substitutes like cat bonds help only for certain catastrophe layers, so their dependence remains. Concentrated insurers and brokers gain leverage, especially in harder markets. AXA's scale provides some counterweight, but when capacity tightens, supply terms become more stringent. Since reinsurance is a material cost, this translates to margin and growth pressure, and for forward integration threats, they keep their leverage high.
First, AXA's base of 95 million clients across 50 countries creates massive fragmentation. With 110 billion euros in revenue, no individual retail buyer holds leverage. This lack of buyer concentration significantly weakens buyer power. Second is pricing power. In 2024, revenue grew 8%, driven by a 10% favorable price effect. Because retention improved despite these hikes, it indicates low price sensitivity, which further weakens buyer power. Third is differentiation. Growth in specialized products like unit-linked and capital-light savings proves AXA is escaping the commodity trap. This unique value and brand loyalty effectively weakens buyer power. Finally, a divide in buyer profits. While AXA maintains favorable pricing in SEMs, they moderated rates for large commercial clients. This confirms that while general buyer power is weakened, large institutional clients use their volume to strengthen their bargaining position.
AXA faces a higher risk when it comes to the threat of substitution, although it is at a lower risk from the NHS due to its long waiting times and the psychological lock-in of the fear of the health system. It does need to be aware, however, of the potential care improvements from the current restructuring. Self-pay options pose a larger threat, especially while budgets are being squeezed due to greater choice, no commitment and limited downside where universal healthcare systems exist. The threat posed by wellness tech is also growing. Such technology has the potential to offer high performance through personalization and prevention, limiting the need for AXA's services. However, AXA's health insurance seems to be the most at risk from telehealth, with it purporting to be more accessible, cheaper and more flexible and potentially even more effective. There may be a strong propensity to substitute due to high performance and low switching costs.
Competitive rivalry is one of the strongest forces affecting AXA. AXA competes in a global insurance market alongside large established rivals such as Allianz, Zurich, and many others that all target similar customers. Product differentiation is low. Most insurance products are standardized, so customers mainly compare price and service. This forces AXA to compete on pricing, increasing competition, pressuring profit margins. Growth pressures further intensify rivalry. Metro markets in Europe and North America limit growth, pushing AXA to expand into emerging markets where it faces direct competition from other global insurers. Competition also extends to distribution. Brokers and digital platforms work with multiple insurers, requiring AXA to compete on technology, customer experience, and brand visibility. Finally, intense rivalry drives consolidation. As competitors merge to gain scale, AXA must respond strategically to protect its market position and remain competitive.
The threat of new entrants in the insurance industry is low due to strong structural and regulatory barriers. For AXA, economies of scale are a key advantage as its global operations allow high fixed costs such as compliance, IT, and claims management to be spread across millions of policies. Long-established insurers also benefit from proprietary underwriting expertise and historical claims data, improving pricing accuracy. Entry is further restricted by strict government regulation, capital and solvency requirements, and high switching costs in SME and corporate insurance. While digital insurtech firms can enter niche segments through online distribution, they struggle to scale, build trust, and compete with incumbents, brand strength, and defensive capabilities. As a result, long-term entry remains unattractive. In conclusion, AXA operates in an industry shaped by strong regulation, high capital intensity, and significant structural barriers. While competition and supplier pressure exist, AXA's scale, brand strength, diversification, and underwriting capabilities limit threats from entrants, buyers, and substitutes, supporting its long-term competitive position.